Last year, when most investors were watching their stocks plummet, one Wall Street legend had an unfair advantage that was identifying winning stocks with massive upside. Like Riot Blockchain before it shot up 10,090%, Digital Turbine before it shot up 789%, Overstock.com before it shot up 1,050%. This power gauge comes from the legendary Mark Chaikin. Right now, you can get a free in-depth look at how his power gauge system works. A way to type in any of 4,000 different tickers and see exactly where the stock is most likely to go next, and in any type of market. Simply go to powergaugepreview.com for a free look. Again, that's powergaugepreview.com. Welcome to Making Money. This is Matt McCall. Thanks for joining me. Oh, big weekend, Memorial Day weekend, right? I hope everybody had a great time. So on today's show, it's a bit of a special one. We're going to talk about how the markets react in the summer. Should you sell in May, even though May's basically over, and go away? Or are the summer months actually pretty darn good recently? We'll dive into that. Also, my 6-pack of stocks for the summer for you. 6 stocks that should be added to your watch list. 6 stocks that have everything and anything to do with summer. All that and more coming up right now. Again, this is Matt McCall. Thanks for joining me. This is Making Money. And this is a bit of a special Memorial Day show. It is Tuesday now, the 31st of May, 2022, but we did tape this show previously because just like everybody else, my team and I, we like to take a little vacation from time to time as well. So we taped this one a little bit earlier, but it's okay because these stocks in here I'm going to talk about have to do with the summer and beyond. So we have plenty of time to delve into them. But before I get into that, I want to talk about this old adage that goes around on Wall Street often. And of course, in May is when we usually start talking about it. And it's the old sell in May and go away. And let me give you a bit of a history of kind of where this came from. You know, many, many years ago, the Stock Traders Almanac put this out. And it was really based on the fact that the 6 months beginning in May, so May through October, were major underperformers versus the 6 months from November to April. And a lot of that had to do with agriculture. You know, there's a lot of people farming. So it's when they were in the market, when they weren't in the market. But we really aren't that country anymore. I don't know many farmers, to be honest with you. I don't know if I know any farmers, to be honest with you. So we're not in the same place that we were decades ago. So it doesn't hold up as well, but it's had a good ring to it. So people like talking about it. So what I did is I dove into the numbers, a few different numbers here. And if I take a look since 1990 at the S&P 500, so you're looking at what, about 31 years. The May through October timeframe, so you say sell in May, go away for 6 months. The market was up on average, the S&P that is, up 2%. The November through April timeframe, the next 6 months, the other 6 months, was up on average by 7%. So that's a major difference. But keep in mind, there was some major pullbacks in that May-October timeframe. 2000, a big dump. 2008, October, well, I guess 87 was prior to that, so it doesn't really matter. But there's a few times where we had some major dumps happen in that time frame, that May to October time frame. So it can be skewed a little bit. But those numbers are real. But to me, it's kind of, what have you done for me lately? And last year, believe it or not, May through October was up big, up 10.2%. So selling out, you would have missed really the average of a whole year's gains in 6 months. So that definitely wasn't the right move. So again, 1 year doesn't matter. And obviously last year was post-COVID, people rallying back. So I looked at the last 10 years for the S&P 500. It was up 8 of the 10 times. And the average gain was 5.4%. Again, this is 6 months, not 12 months, 6 months. You add that together, obviously you get 10.8%. That's above the average return for the market over the long term. So I'm not buying this sell in May and go away anymore. And again, the summers can be weird because even though it's not the same as far as agriculture, summers are different. A lot of people on Wall Street take long vacations. The kids are home from school, so things are a bit different. So the liquidity, the volume a lot of times isn't as high as it would be in the non-summer months. So when liquidity is a bit lower, that could lead to increased volatility. With most stocks, folks, I'll be honest with you, and with the overall market, the volume's still so high, you're not going to have a big problem. But some smaller cap stocks, you may see the volume really drop off in the summer. And if that is the case, you could see higher volatility. So if earnings come out, let's say, for the second quarter, and they come out in July, end of July, end of July, you could see a small cap rally or sell off big based on earnings miss or beat, because the market's doing that now anyway. But then you add into consideration a lighter volume, and it wouldn't be surprised to see something like that happen. So again, just keep that in mind into the summer months. But when you hear that sell in May and go away, boy, I wish the market was that easy. It's not that easy. So I don't subscribe to that. It's always fun to talk about, but again, I don't subscribe to it. Again, 8 of the last 10 years we've been up, and one of them was down, I think, 0.1%. So that's basically flat. So one flat, one down, 8 up. I'll take my odds there any day. And again, like I said, on average, the last 10 years, the S&P has been up 5.4% in that May through October timeframe. All right, so let's get into the stocks. My summer 6-pack of stocks. And you'll see they all have a bit of a theme, something to do with summer. Again, nothing here is a buy or sell recommendation, but I just want to educate you on these stocks. And one of the 3 pillars of the show is fun. So let's have some darn fun with this. So the first one I want to take a look at is Boston Beer Company. And the symbol on that is SAM, S-A-M. And the reason the symbol is SAM is because they're known for their number one selling brand, their largest brand, which is Sam Adams Lager. I'm not a big beer drinker, not a big Sam Adams drinker. I mean, I probably drink if I had to, but I couldn't tell you the last time I ordered a Sam Adams or even a beer. So it's not me. However, there's another part of this that people often forget or don't know that Boston Beer owns. So Boston Beer also owns Twisted Tea, which is like a iced tea flavored stuff. Never had it. Angry Orchard, which is a cider. I've had that. It's okay. And the last one, the other big brand is Truly, which is those spiked seltzers. Boy, oh boy, they're good. I will admit, they are good. On a nice day like this, I'm not going to have any, but it's a beautiful day out. Go to the pool. I don't want to drink beer. I don't want to drink anything else. You sip on one of those things, they're really, really nice. And that Truly, I'm going to pull up the chart here in 1 second. That Truly really boosted the price of Sam stock. And let's take a look at it here now. This is long term. This is going back to 2016. I mean, going back here, Sam was struggling in mid 2017. It was around $150 a share. It ran up to about almost $1,400, as you can see here. But this was the big Truly run here when everybody was drinking Trulies. Remember? Now it's come off because there's so much competition. Let me zoom in the chart here a little bit. As I mentioned, over $1,300 a share. It's now down right now to $357 a share. So that pullback that we're seeing there in the stock isn't just the fact that there's not as many people drinking Truly because there's a lot of competition. There's a lot of other things that are going on with this. One of them is the fact that we had this kind of boom of boozing during the quarantine, the pandemic, and then now that people are going back, they're not sitting at home drinking. I mean, you hear stories about how much people drank, unfortunately, during that time frame. So when I look at the company, there's a few things here that I see, and one is it's a $4.3 billion company. In 2021, it did a little over $2 billion in sales, $2.05 billion. So that's pretty nice considering it's only a $4.3 billion company. However, I look out to 2024, it's only expected to generate revenue of $2.58 billion. So you're not seeing real big growth on the upside. So it's not a growth story. As far as earnings are concerned, they do impress me. This year, we're looking for earnings per share of $12.81. 2 years from now, 2024, $19.11. So you're seeing some nice growth there. Trades with a forward PE ratio of 21.2, forward price of sales 1.78. So it's not cheap. It's not overvalued. It's kind of, I talk about that pendulum, it goes back and forth like this. It's kind of fairly valued here, in my opinion, just because you're not having that big top line growth. If I look again back at the chart here, it's pretty ugly, and I don't want to try and catch a falling knife. And I could zoom way out here on the chart and see how much it's given up. And yeah, maybe it's find some support around 300. I don't know. I may want to put in a watch list just to be safe in case it does start to turn around. But for right now, I just keep an eye on it. I wouldn't do anything more than that. So that's stock number one in the six pack. Number two is something that I've never gotten. I don't understand this brand, but I am not always the best when it comes to this type of consumer goods. And that's Yeti, Yeti. $4 billion company as well. And they're known obviously for their like coolers that you put around koozies, whatever, the metal koozies, the big coolers you take things. So obviously you're going to the beach, you're going camping. Yetis are big. You go to the pool, you got your little beer koozie or whatever it is. Extremely expensive, in my opinion, for what you're getting. Some of the Yeti brand is the big one. They also have Tundra, Hopper, Rambler, and many, many more other brands out there as well. So this company generated revenue last year about 1.41 billion, looking for 1.69 this year, up to 2024 about 2.2 billion. So not huge growth here either. Earnings per share last year $2.57 a share, looking for 2.90 this year, $4.03 in 2024. So you definitely see better growth on the bottom line, which is great. That is actually, it just means it's becoming more profitable and the margins are getting better, which is good, which is a really good sign. But you want to see sales increase as well. Forward PE ratio of only 13, price of sales 2.05. So based on earnings, it's a little cheap for me, which is nice. And let me pull up the chart here for you, so you have an idea of what we're looking at. There you go. There's Yeti. Very similar chart to a lot of things out there right now, where it topped out in November and it's pulled back, lost over 50% of its value. But you can see the long-term chart. It was down in the low teens, ran all the way up to over $105, and now back down to about $46 today. I was below 40 just last week. Just this week, last week it was just under below 40. So it's had a big bounce back already, 15% from the low. Geez, over 15%, as a matter of fact, for the intraday low. So you've seen it really come back quite a bit. This is one where, again, I don't get it. I just don't understand why you spend so much on coolers, because I remember reading a review maybe 2 years ago or so about, I think it was at Target or Walmart, basically selling a cooler that looks just like a Yeti, different brand, obviously, but the review said it was actually better than a Yeti. It was like 1/3 the cost. I think you're paying for a name brand, but especially down south, I never even heard of Yeti until I lived in Nashville a few years ago. I was there for a short amount of time, and going to the pool in the summer, everybody had their Yetis, coolers, their koozies, everything. It's a big Southern thing. Again, I don't get it, but doesn't mean the company's not good. Doesn't mean the stock's not good. I personally just don't understand it. So that's number two of your six pack. Three, and this is one. This is an industry I know quite a bit about because I'm on a plane. I feel like at least once or twice a week recently, but I've been home for like a week now, so which is nice. But I will be getting on a plane in a few days, so I will be back on plane soon. So the airlines, that's basically a summer stock because a lot of people are traveling. Several airlines last week came out and updated their mid-quarter guidance. They're at a conference. And Southwest, JetBlue, both basically came out and said things are better than we thought and raised guidance. And Southwest in particular, and the symbol there is LUV, L-U-V, they cited strong demand and pricing power. So even with inflation, being out there, they're passing that pricing along. And I despise Southwest, though I fly it all the time because it's the only nonstop I can get to the home office in Baltimore sometimes, and I'm not stopping. But I like having my seat. You could call me spoiled, but I like having a seat, even though we always get the A's and you get in front, whatever. But yeah, I don't want to be fighting people for a seat. I just don't want to do that. I would like to know where I am. I could be the last one on the plane. It doesn't matter. I don't need to rush on there. But I have to rush on now because I want to get a good seat in the front so I can get off. So that's my big thing against Southwest. The flight attendants and the people always are super nice and happy. I'll give you that. They're really, really good people. But it's kind of surprising that the airlines are coming out with such bullish news because you think about it, there's not only higher fuel costs, but higher labor costs too. And again, they're passing that along to you and I. I booked the tickets. I see how much they cost. So Southwest, $27 billion company. 2019, they had the high of revenue. That was our previous high before the pullback in 2020, obviously, with COVID. They had $22.43 billion. And then this year, looking for $24.1 billion. So better than the highest it's ever been. By 2024, $28 billion in revenue. It lost about $2.15 last year. And obviously 2020 lost a lot more. But this year, back to profitability, expect to earn $2.53 a year. or this year, and then by 2024 up to $4.82 a year in earnings. But that's still below the high in 2017. I did notice going back at the old numbers. And let me pull up the chart here for you. I want to give you an idea what it's looking like, because it's actually not that bad. It's a bit constructive here. Again, this is Southwest Airlines, symbol LOVE, LUV. You can see here since December, it's been going sideways, building a base. That's pretty important. And it's about to be above both the 50-day moving average, which is red, the blue 200-day moving average about to be above that. So it's building a base. I actually like the action. I can never bring myself to buying it for the simple fact that it just drives me nuts. This company drives me bananas. So I could never actually do it. But again, this is your six pack number 3. Number 4 is Pool, Pool, which is Pool Corp. And if anybody out there is building a pool or trying to get somebody to come build a pool, ever since the pandemic, the demand for pools and people who build a pool has gone through the roof. And this stock has done very well. And is there still? I have a friend building one now, and I think it was supposed to be done last year, and I think that it should be done soon, just in time for summer. But it's pretty amazing just the demand, what was created during the pandemic. So let me show you a chart here real quick. This is symbol Pool, Pool, one of the largest pool manufacturers. You can see it went up to a high of 580, back down to 400 right now. So it hasn't got hit nearly as hard as a lot of other stocks. But let me zoom out and just show you this stock. I remember following this stock, my God, so many years ago. I think it was back in like the early 2000s. I mean, just because I thought it was a kind of funky symbol. Stock back there, $11 or so. Let's call it $10. Obviously would have been a 57 bagger or so if you would have held on for that long time frame. But it looks good. There hasn't been many pullbacks along the way. Obviously, 08, 09 recession that we had. Other than that, there's only been these kind of little pullbacks from time to time until recently, and this pullback that we've had. So I do like this company, and this is one I'm definitely put on a watch list. As I mentioned, $16 billion company. Last year did $5.29 billion in sales. This year looking for $6.34. 2024 looking for $7.15 billion. So you're not seeing huge top line growth. Last year made $15.18 a share. This year looking for $18.59, up to nearly 21 in 2024. Again, not huge growth. And PE ratio of 20.5, price to sales 2.4. So about fairly valued. It's weird because I talk about this pendulum all the time, oversold, overbought, oversold, and I'm like, it never stops actually fairly valued. Some of these stocks right now are a bit fairly valued, believe it or not. I think they've actually come down. So a company like this, could it get cheaper? Of course it gets cheaper, but it is also getting to a level that, again, it suddenly becomes a bit attractive. So that's number 4 of your 6-pack of summer stocks. The next one, number 5, is 6. Well, this is kind of funny. I'm going to flip them around. How's that? Number 5 is Airbnb, and the symbol is ABNB, just as it would sound. So Airbnb, everybody knows, right? Airbnb, it's funny. I put it on the list because I'm not a fan of Airbnb. I've stayed in a few, I haven't in many years, but I stayed in one in Santorini, Greece once, and the pictures were great. And one of the things that I asked the person before I booked it I was with my ex at the time. We were over there, we were bouncing around Europe. So we booked it kind of last minute. And I said, I want to have a view of the caldera. This was on Santorini looking down because I'd been there before. It's a great view. He said, absolutely, absolutely. Get there, there's no view to caldera. With this little window like this big went the other way. No view of anything. So the gentleman was kind of nice at first, and I asked him, I said, this is not true to what you said. I said, I'm going to cancel this and go somewhere else. And he goes, well, if you walk across the street down the thing, you can see the caldera. I said, well, that's not what I asked. So long story short, I left, and we got a beautiful little hotel right down the hill with a beautiful view, and it ended up working out, being great, meeting good people. So when I got home, I emailed Airbnb and said, hey, listen, I want my money back because of this. And they said to me, I have to prove I couldn't see it from there. Of course, I was no longer in Greece. Instead of saying he has to prove it, which he couldn't do. Well, anyway, it stuck with me. But I just don't like it. I don't want to stay in somebody else's house. I like the conveniences of a hotel. I like having the gym. I like having room service. The internet's going to work. You got a restaurant downstairs. I prefer it better. Anyway, so $75.8 billion company. They get about 54% of their sales from North America. They also get about a third of their sales from Europe, Middle East, and Africa. Their revenue all comes from transaction fees. So, makes sense there. They had a dip in 2020 in revenue, obviously, down to about 3.37 billion. Last year, 6 billion. This year, looking for 8.26. In 2024, looking for 11.8 billion. Back to profitability this year, about $2.70 a share. And then 2023, $2.80 a share. So you're not really seeing any growth on the bottom line here. So let's pull up the stock and then we'll take a look at it. So here's Airbnb again, symbol ABNB. It's trying to bounce off the low. It's really a choppy chart, to be honest with you. You can see it went public here back in late 2020, and kind of ran up, down, and then it broke this low. So it's got to get it back above 130. I know it sounds weird to say above, but it has to get back above into that range. If it does, it actually looks more attractive to me, and I can kind of put that 130 line right there, as you can see, because you have support there, 4 times, and it broke it. That's now resistance. So it could rally up, and if it fails there, this should probably continue the downtrend, to be honest with you. So that's one. Again, there's summer stock, so you got to put it on your watch list, but I'm not a huge fan of Airbnb right now. And then the final one, number 6 of the six pack, the symbol is SIX, S-I-X, Six Flags Group. So you probably know them as theme parks. They have 23 theme parks in the U.S., 1 in Mexico, or 2 in Mexico, 1 in Canada. It's about a $2.58 billion company. Again, their revenue got hurt in 2020. A lot of these are related to travel and tourism, and things are shut down. Fell to 356 million, but last year back up to 1.49 billion. This year looking for 1.67. Next year 1.74. So again, not huge growth on the upside. 2020 they lost $4.87 a share. Obviously with the pandemic. Last year made $1.50. This year looking for 252. Next year looking for 284. So when I look at those numbers, they're not horrible, but again, they're not, you're not seeing this huge growth, and I think a lot of this stuff has been priced back into it. And if you look at the forward PE ratio, it's 10.4, price of sales 1.47. So yeah, they're actually not horrible numbers as far as just flat out valuation concerned. So let's show you the chart here real quick. The one thing I don't like about the chart is we were kind of consolidating for months, and then you can see how many times we found support at 36. Huge volume breaking 36. So we could see a rally back somewhere around here, and it might fail. Again, long-term chart's not looking as good. And, it took the big hit, obviously, with the pandemic, but it was already falling prior to that. So, I mean, maybe it does come back. Maybe we do have a big theme park revolution. What's funny is I don't like theme parks either. I'm not a big fan of heights or motion, getting whipped around. Funny story before I wrap up. As a kid at St. Teresa's Elementary School in Pennsylvania, we used to go to Dorney Park, was close by in Allentown, Pennsylvania. And I'd always play sick that day because I was afraid to get made fun of because I didn't want to go on any of the roller coasters. So I was sick that day. So yeah, my secret's out. I don't like roller coasters. Anyway, folks, I hope you had a wonderful, safe, happy, family-fueled, food-fueled week and Memorial weekend and on the holiday. Enjoyed the day off Monday. And, Memorial Day is about memorializing people who have fallen before us to keep this country great. So my heart goes out to them as well. So thank you so much for watching. Thank you so much for the support. I hope you enjoyed your summer six-pack of stocks. We'll be back Thursday with a great interview coming up for you. Thank you so much for watching. I'm Matt McCall, and that was Making Money.
Opinions expressed on this program are solely those of the contributor and do not necessarily reflect the opinions of Stansberry Research, its parent company, or affiliates.